for day traders. Chris Weston here, head of research at Pepperstone, and today I want to look at the gold market. We put our video out last week about what was happening in gold. Got a pretty good response to it. I think people are quite keen to see gold and how it's traded from a multifaceted perspective, and we want to have a look at not just what's happening in the technicals, which I think obviously is very key, just understanding a little bit how people are seeing price action, the sort of flows you've been seeing there as well. But we can have a look at things like positioning, we can have a look at options pricing, we can have a look at the backdrop, and we can also look at statistically what is making gold move, what is the influence of that price, and we can use regressions and rolling correlations to understand what is the key driver, and that can give us a bit of an edge of trying to understand what our risks are in this market. But let's have a look at the backdrop first by which gold's got to operate, because the backdrop has become somewhat more compelling. Of course, people are looking at the coronavirus in somewhat of a new light. That can change. Obviously, the situation remains very fluid. But if you look at recovery rates, they're improving. If you have a look at what the PBOC doing, they're really trying to suppress market volatility. They're throwing the absolute kitchen sink at increasing liquidity, trying to keep HIBOR and SHIBOR rates low. You're trying to see dollar CNH moving back above 7. You've seen the equity markets respond pretty well on the back of that. There has been some better data of late around the world, but the idea here is that Chinese economics are going to obviously take a hit. How much of that is priced in? But central banks at the moment continue to be very much behind the curve, or very much behind the wheel here, trying to steer and suppress volatility, and that's obviously being led by the PBOC, who obviously can't really do too much from a humanitarian perspective to contain the crisis, but they can influence market suppression, and that's what they've been doing in terms of volatility. Have a look at the S&P 25 or 1 month 25 delta calls versus puts, or what we call the risk reversals, or the skew between the implied volatilities there. You can see there had been a significant demand for put volatility, so obviously people looking to try and protect their portfolios using S&P puts, and that volatility has come back somewhat in favour of calls. You can see that's a reflection of what's happening in sentiment. Markets are getting somewhat infused to reduce some of those tail risk hedges from their portfolio. You can see that in the put call ratio, the CBOE put call ratio, that's come back a little bit there. And of course, I think those factors, and we really like to have a look at what's happening in Aussie yen. We think it's a really good proxy for what's happening in the global concern around what's happening around coronavirus. You can see specifically in implied volatility, it's about at the front end, that has come down relative to longer term implied volatility. That's usually quite good for spot in the first place. But it's telling you that short-term volatility is falling, and that's again a perception about what's happening in semantics. And you can see that resonating in the gold price. People had been using gold as a hedge against this kind of madness we've been seeing in the world, a hedge against what's happening in the potential fallout in economics from the coronavirus, not just in China but around the region as well. And you can see here on the chart that we've got here, this is gold priced in US dollar terms, that we're coming down to this horizontal level of 1535. That's just above the head of the 50-day moving average, 1520. We've got this sort of the bottom end of that range as well, around 1535. So that's where it's been consolidating in 1590, 1540, 1535. If we go down to the bottom of that range, will we have will the macro backdrop improve, that people are going to take off those hedges and we're going to sort of move down into sort of back down below 1500? That's obviously yet to be seen. What I can do is give you levels. What we do as traders is we see how markets react around those levels. What's the sort of price action we'll be seeing, and that can tell a lot. And of course, as traders, we react around there. If we do see a bounce up, the question is, do we get back up to the top end of the range at 1590? For me, there's a high probability that would happen, but we'd have to wait to see how it happens. And then, of course, I'm going to turn more bullish on gold and expect a nice, positive trending conditions again if we can get a weekly close above 1590. Until that time, I think we're going to probably chop around. We're still looking to see how price reacts around 1530. If it breaks through there, then maybe turn a little bit more short-term bearish at the margin, because it will probably coincide with what we've been seeing in this environment. Have a look at risk reversals in gold, because I think if you have a look at it in dollars, again we're looking at risk reversals, looking at that skew of 25 delta 1 month gold calls relative to put volatility, and you can see that volatility difference is a 2-vol difference. That's pretty neutral. I know it tells you still that people are paying up for call volatility, which gives you upside in gold relative to puts, but it's pretty neutral if you have a look at this long-term chart. And again, I think that's probably fair. It's starting to roll over a little bit. Call volatility is starting to pull back relative to puts. That's something we've got our eye firmly on. We're still seeing gold underperform a little bit over the last 5 days. That's something that was different from last week. Even in Aussie dollar terms, we're seeing gold down about 0.5% or so. So it's difficult to know what weapon to choose. Do you choose dollars? Do you choose euros? Do you choose Aussie dollars? For me, it's very difficult. When you go look ahead at the rest of the week, we've got our eyes still firmly on what's happening in the coronavirus. But do keep an eye on what's happening in the US data flow. I think that's going to be very influential this week, even though we know that coronavirus will impact US Q1 GDP, and a lot of those metrics like the ISM, which came out the other day, will roll over a little bit when we get future reads, the February read, for example. We've got the services ISM later this week, and of course we've got non-farm payrolls coming through. The US election is a bit of a surprise, probably anti-gold, working against gold, because what we've seen is Pete Buttigieg doing very well in the Iowa caucus. Of course, that was an absolute kerfuffle. It's a schmozzle. But it does look like Pete Buttigieg has done pretty well in that. Bernie Sanders has done okay. I'm not sure how much we read into that. It does seem that Bernie Sanders will still be favourite to take out the Democrat nominee. But what we have seen, I think, categoric here is that Joe Biden's chance here have fallen away. So are we going to see Michael Bloomberg step up? Are we going to see Sanders take that nominee? Obviously that has big implications for the gold price as well. Have a look at the volatility, the correlation matrix, which I've got here. As you can see in the middle chart, we've got the 20-day correlation and we've got the 12-month R2 correlation as well. So we're just looking at different metrics of these key influences relative to the gold price. So I've looked at the treasury market specifically. I love looking at what's happening, the influence that bond yields have on gold prices. You can see how I've conditionally format anything which has got a negative spot 0.75 or below or below than that point, and you can see that 2-year treasuries at the moment on a 20-day rolling correlation basis, negative spot 7.8. The highest on this, on the negative side, so it has an inverse relationship. So yields are going down, gold price is going up. Actually, is dollar yen at the moment. That's quite an interesting one. So on a correlation basis, on a rolling basis, it's actually dollar yen, and I think that's probably fair because dollar yen and treasury yields are so correlated. They're pretty much one of the same. So if you're trading dollar yen, you might as well have an influence on what's happening in bond yields as well. In terms of actually a regression, so we're getting both data sets, and we're doing a regression to see the influence there, and using the 2-year treasury or 10-year treasury or real yields, which real yields are effectively the 10-year government bond, and we're adjusting that, or we're minusing inflation expectations for 10 years. That's really important for fund managers to understand, the expected returns once they adjust for inflation expectations. And what we're using them as the independent variable. And we can see that effectively with 10-year real treasuries that 83% of the variance in gold's price can be explained by the treasury market there as well. So we know that the bond market's incredibly influenced by what we're seeing there. The dollar index, rolling correlation of 0.50. It's pretty neutral there. I think when you're looking at positive correlations, what really springs out to me is the VIX at 0.81. So as the VIX has been pushing up, the VIX being the implied volatility in the S&P, it's a perception about the expected movement in the S&P over the coming 30 days. There's been a strong positive correlation between those two. So that makes a lot of sense. People are using gold as a hedge against what's happening there. You've probably seen a higher VIX, you've seen lower bond yields, and those two are probably correlated as well. So it kind of gives you a sense that people have been using gold as a hedge against the economic fallout from what's happening in the China's virus there. But also the dollar value of the negative pool of debt that you've been seeing globally. You've got that sitting around $13 trillion, and that positive correlation sits at 0.90. Regardless of what's happening in the regression side of things, which looks at a slightly different data set, if we're looking at those rolling correlations, you can see that it's really a bond market that's making gold move. And how do I look at this, quite frequently? Have a look at this chart here that we've got from Bloomberg. Have a look at the middle pane, and you can see how I'm seeing this. This is the correlation between gold and the 10-year real the inflation-adjusted treasury market there. You can see that currently sits at negative spot 7.9, but that correlation is improving. You can see within that multi-year range, if you take that out to a 5-year range, that 10-year real treasury has got as low as negative spot 9.7, which effectively means it's moving tick for tick. So bond yields lower, gold price higher. negative situation. Then we've got the regression there. So this is what I'm trying to do, is I'm trying to understand just how influential these markets are for when for the gold price coming through. You can see that the pool of negative yielding debt has shrunk last couple of days. Recently we got up to 13.88 trillion. That's come down a little bit recently, and that's probably why we've been seeing gold under a bit of pressure, but that correlation obviously been very strong. That pool of negative yielding debt a few weeks ago stood at 10.91 trillion. That pushed up to 13.88 trillion. And that's rolled over a little bit now. So I think with yields moving a little bit higher, that pool of negative yielding debt has somewhat subsided. Let's have a look at positioning as well, because you can have a look on the Commitment to Traders report that comes out every Friday night in the US or Saturday morning for us here in Australia. I mean, this measures futures positions, but I've got options and futures here as a total managed money effectively. We can see 184 net long contracts in gold. Now, if you break that down into gross and shorts on the bottom two panes, you can see net longs have come down a little bit. So that net position has dropped. It's still pretty elevated, but it's really been longs taking a bit off the table, and it's not really been those shorts which still continue to be somewhat subdued. But net long positions still pretty elevated in terms of commitment of traders. Have a look at ETF holdings. ETF holdings really, I put this chart out on Twitter the other day, and people were coming out and saying, I'm going to go short gold just because of this. I mean, it's one variable. Do consider this is probably a very bullish sign, but when you're looking at risk opportunities, and when you do see ETF holdings at record levels, that in itself is, to me, is a very low probability short. You need to see obviously price respond, but it's something that we do weigh up as part of our probability matrix. Gold ETF holdings at record levels, you can see that against the gold price, which I should have put in gold, but I put in blue there. Gold price, obviously moving fairly well in alignment, but those ETF holdings at all-time highs as well. So something we are looking through to the week. We're going to keep our eyes on the non-farm payrolls. We're going to keep our eye on what's happening in the coronavirus situation. But the backdrop has improved. It's a fluid situation, and that obviously can improve, can deteriorate. If we do see yields moving lower, a negative, and both on a nominal and real basis, then one suspects, given that we've seen the correlation, the influence that has, and the likelihood to increase that pool of negative yielding debt, you are going to see gold prices move back to the top of the range. Obviously, the VIX will probably move back up to 18 to 20% as well. But we do see an improvement in that backdrop, the S&P moving higher, implied volatility going lower. Then you're probably going to see gold come to test that 1535 level in dollars. Do we get a break of that level? So certainly something we're watching this week.